Something is breaking behind the scenes, not stocks, not crypto, but the one market that controls everything, the US bond market. Right now, while most people are distracted, the foundation of the financial system is starting to shake. Michael Oliver, the same man who warned before major crashes, says this is not a normal bull market. He says this is a monetary event, a structural event, a once-in-a-generation reset. Silver is not running anymore. It's detaching from gold, from history, from control. And when that happens, moves don't go up slowly. They go vertical. What he's about to reveal connects collapsing bonds, money printing, and a silver price most investors are completely unprepared for. And when this chain reaction fully starts, it won't be stoppable. Welcome back to Market Metal, the channel where we don't chase headlines. We decode what they're hiding. If you're someone who's lived long enough to see housing crashes, currency changes, and experts get it wrong again and again, then this channel was made for you. So take 1 second and subscribe to Market Metal, not for hype, but so you stay connected to calm, clear warnings before the crowd is forced to listen. And tell me something in the comments. Where are you watching from today? Which country? Which city? I read them all. The market signal. Most investors are ignoring. In financial history, the most dangerous moments rarely announce themselves with panic. They arrive quietly, disguised as strength. Prices rise. Headlines celebrate records. Investors feel safe. But underneath that surface optimism, the structure of the system often begins to fracture. According to market technician Michael Oliver, the current rise in gold and silver belongs to that category. He does not describe it as a normal bull market. He frames it as a warning signal. Gold approaching historic highs and silver breaking levels not seen in decades are not, in his view, independent events. They are not the result of fashion, sentiment, or retail enthusiasm. They are responses, reactions, indicators of stress building in parts of the financial system most investors no longer watch. For decades, precious metals were treated as relics. They moved sideways, they underperformed equities, they attracted little institutional interest. That long dormancy, however, created something technical analysts understand well: compression. Long periods of constrained movement store potential energy. When such structures finally fail, markets do not adjust slowly, they reprice. Oliver's work is based not on short-term price action, but on long-range structural momentum. His approach examines how markets behave when they transition from one valuation regime to another. In past cycles, these transitions did not unfold gradually. They occurred in bursts. They marked the end of one reality and the beginning of another. From his perspective, gold and silver spent years building that foundation. Gold rose in steps. It would advance, stall for months, frustrate participants, then advance again. Each pause convinced observers the move was over. Each pause, in structural terms, was reinforcement. The pattern repeated until resistance zones that held for decades were no longer barriers. They were memory. Silver's behavior was even more revealing. While gold slowly climbed, silver remained trapped inside a historical range that had confined it for nearly half a century. That long failure to break free created the perception that silver was unreliable, volatile, and ultimately subordinate. Yet structurally, that prolonged confinement carried a different implication. It suggested unresolved pressure. Markets do not remain compressed indefinitely. When they break, they do not drift, they reset. Oliver points out that silver's recent advance was not simply upward, it was relational. Its value relative to gold began to change. That distinction matters. Absolute price can be distorted by inflation, currency weakness, or speculation. Relative behavior reveals deeper shifts. When silver began to strengthen not just in dollars, but against gold itself, it signaled something more than a rally. It suggested a change in the internal mechanics of the metals complex. Historically, such changes have occurred at specific moments, when capital began to lose confidence in paper structures and move toward tangible stores of value. In those periods, gold often led. Silver followed violently, not because of its industrial use alone, but because it functioned as a secondary monetary outlet when confidence in financial instruments weakened. Oliver does not argue that investors suddenly became interested in silver. He argues that the system began pushing capital toward it. From a structural perspective, this distinction is critical. Investor interest can fade. Structural revaluations do not. When a market moves into what technicians call a new reality, previous price ceilings lose relevance. The market stops asking where it was. It begins discovering where it must be. He notes that similar transitions have occurred in other commodities. Copper experienced such a shift in the mid-2000s, breaking out of a long horizontal valuation and rapidly multiplying in price. Lead experienced it briefly before the financial crisis. In each case, the move did not depend on optimism. It was driven by stress within the broader system. Silver, he suggests, is now entering that same category. What makes the present moment unusual is not simply that metals are rising, but that they are rising while traditional risk assets remain elevated. Stocks have not collapsed. Credit markets on the surface still function. Yet gold continues to attract capital and silver is accelerating. Historically, this combination rarely persists without a deeper driver. Oliver emphasizes that metals do not lead celebrations. They lead problems. They tend to strengthen before inflation is acknowledged, before currency confidence erodes publicly, before financial structures fracture visibly. In this sense, gold and silver are not forecasting growth. They are pricing risk. For business leaders and capital allocators, this reframes the question. The issue is not how high metals can go. The issue is why they are going at all. Long periods of sideways behavior condition markets to ignore certain assets. When those assets break free, it is rarely because their story improved. It is because the competing stories began to fail. Capital does not abandon productive systems lightly. It moves when trust shifts. In Oliver's analysis, the metals are responding to pressure building elsewhere. They are not the source of instability. They are its reflection. This is why he describes the current phase as different from prior rallies. The movement is no longer laborious. It is accelerating. Pullbacks are shrinking in duration. Resistance zones are being crossed more quickly. Markets that once required months to digest advances now resolve them in days or even hours. Such compression of time is characteristic of transitions, not trends. When markets enter this phase, they stop negotiating. They reprice. The surface narrative still focuses on prices, on records, on targets. But beneath that discussion lies a more important development: the return of monetary behavior. Assets that spent years acting like commodities are beginning to act like currencies. They are responding to confidence, not consumption. From a strategic perspective, this alters the entire framework. Business communities are accustomed to analyzing earnings, productivity, innovation, and growth. Those variables remain relevant, but they operate within a monetary environment. When that environment begins to destabilize, price signals across all sectors distort. Oliver's central claim is not that metals are attractive. It is that they are early, and early signals are rarely comfortable. The structural breakout in precious metals raises a question most participants would prefer not to confront. If gold and silver are repricing, what is being devalued? What foundation is losing credibility? Which market is no longer absorbing stress? He suggests that the answer does not lie in equities, technology, or geopolitics alone. It lies in the one market large enough to distort all others when it malfunctions: the bond market. And it is there, he argues, that the real engine of the current shift can be found: the bond market, where financial crises are born. Financial crises do not begin in stock markets. They begin in credit markets. More precisely, they begin where trust itself is traded, in government bonds. According to Michael Oliver's structural work, this is where the current story quietly shifted from an ordinary metals rally into something far more serious. Most investors are conditioned to watch equities. When stocks fall, fear appears. When stocks rise, confidence returns. But equities are not the foundation of the financial system. They are built on it. Beneath them sits the bond market, a market so large, so deeply embedded in banking, pensions, insurance, and sovereign finance, that its movements determine the cost of money itself. Trillions of dollars do not flow through stock exchanges. They flow through sovereign debt. This is why Oliver does not describe weakness in bonds as a sector problem. He frames it as a systemic one. When government bonds fail to behave as stabilizers, the architecture of modern finance begins to lose coherence. The long-term U.S. Treasury market, which traditionally absorbs fear and provides refuge during instability, has not performed that role. Instead of stabilizing, it has fractured. From 2020 into 2022, long-duration U.S. bonds suffered a collapse in price unprecedented in modern financial history. Yields surged. The cost of long-term money rose violently. In normal cycles, such moves are followed by deep recoveries. Markets heal, structures reset. This one did not. For nearly 3 years, bonds attempted to recover. Multiple rallies formed, each failed. Each recovery stalled at lower and lower structural ceilings. To surface observers, these were just fluctuations. To technicians who study momentum and structural integrity, they were warnings. 3 failed recoveries in a market of this scale are not noise. They are exhaustion. By late stages of this process, long-term treasuries were no longer acting like instruments of safety. They were behaving like distressed assets. Prices slipped back toward their crisis lows. Daily trading ranges narrowed. Liquidity appeared artificial. The market no longer reflected organic buying and selling. It reflected management. Such behavior often emerges when authorities are active but ineffective. Central banks can influence short-term rates. They can flood banking systems with reserves, but long-term yields respond to confidence. They reflect whether capital believes a currency will preserve purchasing power over time. When that belief weakens, no policy statement can restore it. Oliver's analysis suggests that this is precisely what began unfolding. Bonds were not merely falling, They were failing to recover despite intervention. And when long-term debt fails to respond to policy, the next phase is rarely orderly. It is panic. Bond panics are not market events. They are political events. They force emergency responses. They compel currency creation. They rewrite fiscal behavior. In a bond panic, governments are not managing growth. They are defending solvency. This is why Oliver uses language rarely applied to financial commentary. He refers to sovereign bond failure as a nuclear scenario. Bond markets finance governments. Governments underpin currencies. Currencies measure all other assets. When that foundation destabilizes, every market above it must reprice. And repricing rarely favors paper claims. As bond prices weaken, yields rise. As yields rise, debt servicing costs expand. Governments then face a choice: allow markets to discipline them or override markets by printing currency. Historically, when debt loads are large, discipline is not chosen. Currency expansion becomes policy. This is the bridge between bonds and metals. When central banks intervene aggressively in sovereign debt markets, they suppress the symptoms of crisis while amplifying its cause. They protect bond prices by increasing the supply of money. But money supply growth does not disappear. It diffuses. It migrates. It surfaces in asset inflation, commodity inflation, and eventually consumer prices. Gold historically reflects this process. It does not rise because economies grow. It rises because currencies weaken. It does not react to prosperity. It reacts to preservation. Oliver notes that when bonds began to fracture, gold did not spike immediately. It climbed steadily, methodically, as though absorbing flows without spectacle. Silver lagged. Then, after years of suppression, it began to respond violently. This sequence is not new. In past monetary dislocations, gold often acts first, absorbing institutional flows. Silver follows later, when stress spreads and confidence erodes at the public level. The violence of silver's move historically reflects not speculation, but acceleration, capital searching for exit velocity. The most dangerous feature of the present moment, in Oliver's view, is not the decline in bond prices. It is the compression of time. Failed recoveries have shortened, rallies have weakened, interventions have produced less effect. This pattern, seen repeatedly in past systemic events, suggests proximity to threshold. Markets rarely drift into crises. They cross into them, and when they do, the mechanics change. Liquidity becomes one-sided, correlations converge, intervention escalates, currency creation accelerates. At that point, precious metals no longer trade as commodities. They trade as alternatives. From a strategic standpoint, this is the pivot business leaders often miss. Metals are not forecasting prosperity. They are front-running policy. They are pricing the responses authorities are forced to deploy when bond markets no longer self-correct. Oliver's analysis implies that the metals rally is not leading the story. It is following it. It is responding to a deeper malfunction that is only beginning to surface. And if that malfunction is indeed centered in sovereign debt, the implications extend far beyond price charts. They reach into capital structure, financing conditions, valuation frameworks, and ultimately, currency credibility. This is why he urges observers not to ask where silver is going, but what it is reacting to. Because if the bond market is entering a failure phase, then silver's acceleration may not be the climax. It may be the introduction. Silver's structural break. When pressure becomes release. For decades, silver occupied an uncomfortable place in the financial system. It was too monetary to be treated like an industrial metal, and too industrial to be treated like a currency. It drifted between identities. Investors dismissed it as erratic. Institutions sidelined it as insignificant. Central banks ignored it entirely. Yet history records something different. In periods when confidence in financial structures fractures, silver does not drift. It detonates. Michael Oliver's work does not approach silver as a trade. He approaches it as a pressure vessel, a market that has been constrained so long relative to its historical role that any structural failure is unlikely to express itself gradually. Silver spent nearly half a century confined beneath a ceiling first defined in 1980 and revisited in 2011. Each time it approached that boundary, it was rejected. Each failure reinforced the belief that silver was incapable of sustaining monetary relevance. Each rejection, however, also increased structural tension. Markets that remain suppressed do not forget. They accumulate. The critical development, in Oliver's view, was not simply silver moving higher. It was silver moving differently. For the first time in decades, it began breaking out not only in nominal price, but in its relationship to gold. That distinction marks the difference between enthusiasm and regime change. Gold is not just another metal, it is the reference asset of monetary history. When silver strengthens against gold, it is not rising in isolation. It is being revalued within the monetary hierarchy. Oliver tracked this relationship through what technicians call a spread structure, the price of silver expressed as a function of gold. For years, this structure formed a hard ceiling. Silver could not penetrate it. That ceiling represented suppression, whether by market forces, institutional behavior, or structural inertia. Then it failed. The breach did not attract headlines, did not generate commentary. It occurred quietly, on charts few investors examined. But from a structural perspective, it was the signal. It meant silver had escaped its historical containment. As when such containment breaks, the market does not negotiate. It resets. Oliver's research identified only a handful of prior moments where silver accomplished this. In each case, what followed was not a rally, but an event. In the late 1970s, silver multiplied several times in less than a year. In 2010, 2011, it surged more than double in a matter of months. Those moves did not occur because silver became fashionable. They occurred because monetary systems were under strain. The present context is not less severe. It is more. Unlike earlier cycles, today's monetary environment is defined by debt saturation. Government balance sheets are not strained, they are burdened. Central banks are not fine-tuning, they are stabilizing. The room for error has narrowed. The margin for credibility has thinned. In such environments, markets stop pricing assets. They start pricing escape. Silver's long dormancy becomes critical here. While gold has functioned as a monetary hedge for institutions, silver has been unavailable at scale. It is smaller, less liquid, more sensitive. When capital flows reach it, they tend to overwhelm its structure. This is why silver rarely trends. It compresses, then it breaks. Oliver describes the current phase as release, years of containment meeting systemic pressure. When those forces intersect, markets often move in a manner that appears irrational only to those still applying normal frameworks. One of the most dangerous assumptions investors make is that vertical moves are unsustainable. In commodities, vertical moves are often the mechanism through which suppressed markets correct. Silver's acceleration reflects this process. Pullbacks that once lasted months now last days. In some cases, hours. Resistance that once capped advances dissolves quickly. Volume expands into weakness rather than fleeing it. These behaviors indicate that the market is not being driven by retail emotion. It is being driven by structural demand. Structural demand does not chase, it absorbs. Oliver also highlights a recurring feature of silver events, the midpoint disruption. In previous surges, silver often paused violently midway through its advance. Price would reverse sharply, convincing participants the move had failed. Technicians would label it exhaustion. Momentum would appear broken. Then, the market would detach again with greater force. These interruptions are not terminations, they are transfers. They shift ownership from early participants to institutions and from leveraged positions to stronger hands. When silver resumes, it does so with reduced resistance. In a market already defined by compression of time, such midpoints can unfold quickly. They can be measured in days rather than months. When this happens, participants accustomed to gradual adjustment find themselves displaced by speed. The true suspense in silver's current behavior lies not in its upside potential, but in its implication. Silver is not merely responding to gold, it is responding to the same force that is destabilizing bonds. It is reacting to credibility. Currencies do not collapse in price before they collapse in confidence. The confidence collapse expresses itself first in alternative monetary instruments. Gold absorbs it quietly, silver often amplifies it. Oliver's framework suggests that silver's structural break is not a conclusion. It is a symptom, a visible manifestation of pressure that is still building beneath the financial system. If the bond market is weakening the foundation and gold is absorbing institutional distrust, then silver's emergence signals the spread of that distrust into broader capital behavior. That stage is historically brief and historically violent. For business leaders, this phase carries a strategic warning. Markets that enter release states are no longer governed by valuation metrics. They are governed by urgency. Liquidity becomes directional. Price discovery accelerates. Assets that were irrelevant become pivotal. Silver's break from its historical ceiling may be remembered not as a successful trade, but as the moment when the financial system began signaling that its internal balance had shifted. The only remaining question is how far that shift must go before the broader economy is forced to recognize it. The monetary reckoning. When systems reveal their weakness, approx. 800 words. Third person, analytical, urgent, suspense-driven, powerful. Financial systems rarely collapse loudly. They corrode. They lose coherence. They begin sending signals that appear disconnected until, suddenly, they are not. According to Michael Oliver's structural interpretation, the simultaneous fracture of sovereign bonds and the violent repricing of monetary metals represent precisely that moment of convergence. At this stage of systemic cycles, markets stop behaving independently. Bonds no longer stabilize equities. Currencies no longer anchor commodities. Policy no longer calms capital. The mechanisms that once absorbed shock begin transmitting it. This is the threshold phase. Historically, when this phase is reached, the defining force is not recession or growth. It is trust. Modern financial architecture is built on layered promises. Governments promise solvency, central banks promise stability, institutions promise liquidity, and currencies promise continuity of value. When those promises hold, markets function. When they weaken, markets transform. Oliver argues that the current behavior of gold and silver cannot be explained through inflation narratives alone. Consumer prices lag, employment data lags, even corporate earnings lag. Monetary instruments do not. They respond to credibility, not comfort. What makes the present moment particularly dangerous is not that money is being created. Money has been created for decades. It is that the creation is no longer expansionary. It is defensive. When money is printed to stimulate, it aims to encourage risk. When money is printed to stabilize, it aims to prevent collapse. The latter is not growth policy, it is damage control. In damage control regimes, currencies cease to function as stores of value. They become instruments of continuity, used to preserve systems that cannot support themselves organically. This transformation is rarely announced. It becomes visible only through the assets that cannot be manufactured. Gold historically identifies this shift. Silver often confirms it. From a business perspective, this is the pivot point most misunderstood. Rising asset prices are often interpreted as prosperity. In late-stage monetary cycles, they are often symptoms of dilution. The unit of measurement is weakening, making all measured assets appear stronger. This is why Oliver frames the metals advance not as a profit opportunity, but as a monetary report. It is documenting the declining purchasing integrity of currencies. He draws attention to long-term money supply behavior. Over decades, monetary expansion compounds invisibly. A currency does not lose value suddenly. It sheds it continuously. The effect becomes visible only when compared across generations. Houses that once cost thousands now cost hundreds of thousands. Assets that once seemed expensive now appear normal. These are not real price increases, they are monetary recalibrations. In such environments, equity markets can perform exceptionally while real purchasing power erodes. Nominal wealth expands, monetary wealth contracts. This divergence explains why advanced financial systems often experience simultaneous asset booms and social strain. Numbers rise, stability weakens. Oliver suggests the next phase of the metals cycle corresponds not to inflationary discomfort, but to recognition. When recognition arrives, behavior changes. Capital reallocates not to outperform, but to preserve. Liquidity concentrates not in growth sectors, but in monetary alternatives. At that stage, markets do not respond to valuations. They respond to credibility. The current acceleration in silver introduces suspense into this process because it implies expansion of awareness. Gold's rise often reflects institutional behavior. Silver's volatility historically reflects diffusion. When silver begins detaching structurally, it suggests that monetary stress is no longer contained within policy circles and balance sheets. It is entering broader capital consciousness. The stage is historically short. When systems move from confidence to defense, the timeline compresses. Decisions once made over years are made in weeks. Policies once debated are enacted overnight. Instruments once dismissed are reclassified. For business communities, this represents not simply a financial cycle, but a strategic environment shift. Financing conditions alter, currency assumptions distort, risk models degrade. The value of cash flow becomes subordinate to the credibility of currency in which it is denominated. Oliver emphasizes that monetary transitions do not require hyperinflation to destabilize. They require inconsistency. When market participants can no longer anticipate policy response, pricing frameworks fragment, correlations break, hedging mechanisms fail. In such climates, volatility is not a feature. It is a byproduct of uncertainty. The suspense surrounding silver's structural break lies in this uncertainty. It suggests that a segment of the market is no longer operating under conventional expectations. It implies that capital is positioning not for opportunity, but for discontinuity. This is why Oliver's work resonates more as a warning than as a forecast. He does not claim certainty of outcome. He identifies probability of transition. Transitions redefine environments. They do not announce themselves through single events. They emerge through synchronized anomalies. Bonds losing stability, metals gaining velocity, time compressing, policy escalating. These are not separate developments. They are components. From a strategic standpoint, the final question is not whether silver can reach specific numerical targets. It is whether the system that previously defined those numbers is undergoing recalibration. If it is, then the metals are not moving toward new highs. They are moving toward new references. And when references change, every balance sheet, valuation model, and business assumption built on the old framework must be reconsidered. Because in monetary history, the most expensive mistake is not being wrong, it is being anchored.